Hello, ladies and gentlemen. Well, as we can see, the risk dial throughout the week more or less remained at 37 and no change, and we're still in risk on throughout. As we have been saying, the score is at 37 both in the daily model and also the weekly model. Not much change there, but the deviations have been telling us basically that we will have a sideways motion. As you can see, they're slowly opening up. We are slowly going towards the middle band, and that is good because that means that we're going towards support in the market. As I've been saying for quite a while now, we are at time 17 Blue Angel, and these lines are really beginning to be very flat. Therefore, if we trade between time 16 and time 17, you can see how much of a drop we potentially could have. We could easily go down towards 2900 and trade 2900 to 3000 for a while without really having changed anything much in the risk profile. As far as the 2-year note, I think we're still in the same range of 192, potentially slightly higher, around the 197 to 199 area, and really 171, 173 is going to be as far down as we can go until we get the Fed decision at the end of the month. I really wouldn't get overexcited in the 2-year. This kind of 197 to 199 area is probably going to be very good to add some longs in futures, but before then I really don't think there is very much to be done in the 2-year note. In the fives we are dead there, 180, really 192 I would like to see trade again, but really 173, 174 is going to be as low as we go. There's absolutely no reason at all to try and force this market with the lower yields. I think the path of least resistance is going to be to this 192 area that's so important, and really 213 is the swing level still, which is this line here. We will not see 213 for quite a while, certainly not in summer trading in July. So really 193 to 194 is the level that we want to be buying some futures. This is a chart of the 10-year, and 213 is the level here, 213 to 215 in the 10-year. If we start breaking it, then we're looking for 220, 225 and this gap fill. That would be a wonderful opportunity, anything below 230 to start setting up some long positions in futures as well. I really don't think that we are going to have too much of a move either way in the next few days while we wait for the Fed, but anything 215 to 220 I will be looking to add to some long positions. As far as the interest rate differentials go, we are still below the 245 level that it's so important. We're minus 238. I really would like this bull flag really to start breaking up, which would indicate to me that the dollar is going to come off. At the moment, no sign of anything, but that is what I'm watching. The interest rate differential to me is going to be very important. If we start breaking below 245 again, chances are that we have a spike in the US dollar. And here we are, the most annoying chart of all, which is the Dixie. We keep on coming back into the range that has held for such a long time, which is basically 96.50 to 97 something, 98 let's call it. It breaks slightly, then it comes back. It breaks slightly on the downside, then it comes back. And really, we really need those interest rate differentials I've just shown you to start moving steadily lower towards minus 200 to have a chance to turn this chart. It might take some time, But I'm very, very conscious that my view is being challenged on a daily basis, and the dollar is just not weakening at all. On a Euro USD, you can see that we are stuck between the 111 and 114.84 levels that are so important in such swings. It's not looking particularly good for dollar bears, I must admit. We just cannot break and stay above the 200-day moving average. If we break this 111 10-ish level, it's going to look very, very bad for dollar bears and very, very good for dollar bulls. This is something that I'm very conscious of, and believe me, I'm looking at all day, every day. As far as equities are concerned, a negative week, but an inside week more or less. I favor the downside simply because I think this 29.52 level will trade, and possibly we have a chance to break it and go all the way down to 28.64. To me, the upside is more or less exhausted simply because of the time 17 Blue Angel, and also because we have another 2 weeks of indecision basically before the Fed. I don't think we trade very far, but I would favor 29.52. Possibly after the Fed 28.64, and if the Fed is not as bullish as in terms of rate cuts as the market suspects. I think all the danger is to the downside as opposed to the upside. I think anything with a 3 handle is just too much for the time being. We have no impulsion to go higher. On a monthly chart, you can see what we've done. I mean, basically we are where we opened the month. We tried the upside, hasn't worked, and now we might try this downside and go and trade this 28.70 area. Which is basically 28.64. That would make a lot of sense to me, i.e. a decent trade down in the next few weeks is something that I would really favor. And the really interesting thing is that we've broken the 15.52.94 level in RUT on a closing basis. You can see that this market could easily come all the way back to below 1500. This is not a healthy position. This is not where you want to be extremely long of ES. As I've been saying, transfer all your longs that you have to hold into calls. And I know that we are in risk on, but that does not stop the market from having a 2-3% setback. To me, it is much more likely that ES will trade down. I would avoid NQ, and now I would avoid RUT. I would just hold some calls, and I would trade the market to the downside. As far as the Europeans go, they've been trading down for 3 weeks now, and they keep on not being able to hold the upside. It is quite possible that we go all the way back to these moving averages towards 11,800-ish. Why not? Below 12,000 would really not surprise. 11,700 would not surprise. What would surprise is a break of 11,600 where these moving averages are. That I do not think is possible. But everything really tells me that the S&P is going to trade down a good 30 points from the close of Friday, and possibly another 80 on top of that. So we are talking, but those are really not huge movements. We're talking about the S&P going back to a very important support level that you know what it is, 28.64, which is what? Not even 4% from the all-time highs. That really should not surprise anyone and is not beyond the realm of possibility. The VIX weekly chart is very interesting, isn't it? I mean, basically we've gone and we've tagged again the 200-day. We could go and tag 1608. That's going to be a very major level. I expect that to be touched when we're trading 29.50, 52, 54, that kind of area, and then we come back off. But if we go then back through it in a couple of weeks' time, here we are, we're going to go to 1813, and that's that 28.64 level. That is what it's telling me. I mean, I don't see it going through there. 28.64 basically to 300 is going to be your trade. 3,000 is going to be your trading range for the next 2 or 3 weeks. So I'm really favoring the downside, simply because volatility is also showing me that it could easily go higher into the 16s. The weekly chart of gold is also very, I don't know, I'm not so sure about it anymore. It keeps on closing around the weekly Bollinger Bands. They keep on trying to take it higher, but it really hasn't broken anything. Now, if it did one of these, would anyone be really surprised? If you went back to 1310, would anyone be surprised? I certainly do not want to buy it here. I'd much rather buy it at 1370, where I can do some reasonable options, or really around this 1310 to 1330 area where the moving averages are bunched. You can see that every time it's broken up here, it came back very, very strongly. So really buying it up here with the US dollar looking as strong as it is, with bond yields looking to move higher, if anything, for the next couple of weeks, and with the stock market as wobbly as it is, I'm not really all that sure. You know, the chart of gold against stocks does favor gold, but I would prefer after 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks of positive price action, I would prefer to see a little bit of a setback. As far as the biases, I have written down, I haven't changed very much the levels in 2s, 5s and 10s, or TLT, or the Bund against the 10-year note 245. What I have changed slightly is the SPX. I now think that 3020, or the top that we've seen, maintains, and now we could easily go down to 29.52 first target, and after that really nothing solid till 28.64, and that is the problem. There is much more downside danger in the SPX at these levels than there is upside. I still don't like NQ, and now I'm beginning to hate even RUT because it closed below that 1552.94 level, and that could really have a very nasty knock of RUT in the next few days. VX volatility is also saying that the likelihood is we go and trade 1610, and I would have thought that that matches to that 29.52 level in XPX fairly quickly next week. European equities, I just showed you, you know, 12,100 is probably a better long, but 11,700 also should not surprise. I think the idea is that we try some longs at 12,100. If that doesn't work, we wait until 11,700. As far as the dollar is concerned, those are still your levels. You know my view, I would prefer it to go down, but I am flexible, and obviously I am beginning to be even more flexible because I am beginning to think that I am wrong, and that is why I'm afraid that gold isn't going to be the kind of performer that everybody thinks it is, simply because if the dollar starts breaking higher, gold is going to have an absolute nightmare. Thank you very much indeed, and this very much counts still. The likelihood of being whipped around in everything is still very high, I think. Tweet to your Monday.